Welcome to another episode of Phillip Trading Podcast. My name is William, and our speaker today is Trent from the Marketing and Dealing Executive of Phillip Futures. So today we will be discussing on what does the latest US inflation means to the global market. As we all know that US has just announced their latest inflation rate 2 days ago. Okay, so with this announcement, what impact can we see on different asset class? All right. So for those that are watching this podcast, feel free to share this section on your Facebook with your friends. Okay. You can also comment in the comment box below to ask us any questions. All right. So Trent, how have you been?
Yeah, I'm feeling good.
Great. All right. Okay. So to start off, let's start with our first question is, what do you think is the outlook of the inflation in the US? Do you think the inflation is going to continue to go up for the remaining of the year, or is it going to stay flat, or is it going to drop?
Okay, just let me briefly explain what happened to the CPI in the past few weeks. So the consumer price index increased 0.6% from the prior month after a 0.4% gain in February, according to the US Labor Department data. So this jump actually is due to the cost of gasoline, which accounted for half of the overall March advance. Then the median estimate in a Bloomberg survey of economists call for a 0.5% rise. So with a 0.6% data reported actually is better than the consensus forecast. However, excluding the volatile food and energy components, the core CPI actually increased 0.3% from a month earlier, which is slightly lower than the 0.6 reported, but is still highest in 7 months and reflecting mainly due to the rising rents and also auto insurance. So the monthly advance in the CPI led to an outsized 2.6% increase in the overall CPI from March 2020, while the core CPI measure rose 1.6% from 12 months ago. So basically year on year, it's actually 2.6% for headline inflation, and core inflation is only 1.6%. So from my opinion, the year-on-year changes are actually distorted by a phenomenon known as the base effect. So the CPI, like many other economic data points, declined at the start of the pandemic due to the lockdown and also widespread business closures. So when compared to those depressed figures, the year-on-year increases from March to May will appear abnormally large. Nonetheless, in my opinion, the Fed predicts that the temporary inflation spikes are to be expected, but there will not be any structural inflation that's here to stay. So meaning to say that inflation is only temporary. So in the coming months, I'm expecting expecting higher inflation rate, mainly due to potential higher energy and commodities prices, along with the COVID-related supply chain bottlenecks.
Okay. So overall, in short, just to put it to a conclusion that the current high inflation rate that we see and of 2.6%, and also the forecast of an even higher inflation rate of 3.8% in the upcoming month is basically factoring into the rise of crude oil prices in the past few months, because crude oil prices has been on the rise in the past since early 2021. So basically, if you think that the upward momentum of the crude oil is going to slow down or is going to reduce, the inflation rate basically will slow down as well. Okay, so next question for you, Trent, is that how should should investors worry about the rising of inflation and also interest rate? Should investors worry about it right now?
Okay, so in my opinion, I feel that the Fed is right in this case, and we should not worry so much about the temporary rise in inflation rate. If you look at the core inflation rate, which excludes the volatile food and energy prices, is currently standing at 1.6%, still well below the Fed's targets of 2%. As one of the main causes of the recent surge of inflation is due to the supply chain disruption, prices of goods will likely to ease once the borders fully reopen. However, many economists predicted the supply chain challenges will need to dissipate during the third and fourth quarter of this year, after majority population in the world had received vaccination. So nothing much to worry. Just expect for a higher inflation rate in the short term.
Okay, so generally, I think your view is the same with the Federal Reserve point of view, which is that the surge in interest in the inflation rate at the moment is just temporary. So investors shouldn't really worry too much about it. All right, the third question here is that what do you think is the impact of the inflation on different asset classes? Is there any particular products that investors should focus in current economic environment?
Okay, so basically there are a few futures products that investor can write on the current economic environment. Firstly is the US stock index futures, such as S&P 500, Dow Jones, and Nasdaq, are expected to continue its uptrend given that the Feds will continue to keep interest rate low till 2023. So the S&P 500 may potentially hit the next big number at 4,200 level, while the Dow Jones may hit the 34,000 big number level. As for Nasdaq, it's currently trading close to major resistance at 14,000, and it's best for investor to monitor how price action will unfold at this level before getting into it. Another future product that I think investors could monitor is the copper futures. As the world economy continues to recover along with an increase in industrial activities, so the copper demand is likely to increase as a major input for the manufacturing sector. Copper prices have been hovering sideways around $4.20 since February. So a break above the consolidation of break above the 420 psychological level, copper futures may push higher to the next major resistance at 450.
Okay, so to conclude, is that the current economic and interest rate environment, very likely in your opinion that US indexes is going to continue to break new high, and copper can be one of the very exciting products to monitor. Okay, so for all of your information that at Phillip Futures, we offer micro indexes on all the US indexes, micro contracts, and together with Mini Cooper, where investors can participate all these products with very, very affordable margin, okay? Just one last questions for you, Trent, before we end. So how can investors protect their investment and also to navigate the opportunities available through the futures contract from the current macroeconomy?
Okay, so in the coming weeks, right, investors who are currently holding position in US equities or US stock index futures should closely monitor the earnings announcement of major US companies such as Apple, JP Morgan, Walmart, and etc. As these companies' earnings may cause volatility in the US indices. Apart from that, right, investors should also watch out for the upcoming US economic data, particularly on the retail sales, and unemployment rate, purchasing manager index, short form PMI, or the gross domestic product GDP. And most importantly is the federal fund rates. Okay, the next few months will be crucial for the US economy as we will see the effects of the government stimulus on the economy, whether the economy will continue growing or may hit a plateau.
Okay, thank you for your sharing today, Trent. So once again, if you are interested to find out how you can participate to trade US indexes or metal-related products, so feel free to drop us a message via our Facebook and one of our representatives will contact you the soonest possible. So yeah, that is all for today. And thank you, Trent, and probably see you next week.
Yeah, see you too.
Okay,
Bye-bye.
thank you. Bye-bye.